everyone. Good afternoon, good evening. This is chapter 3, the double entries accounting system. This chapter explains how to record transactions using the double entries accounting. Let's get started. In this chapter, we learn first 5 learning objectives. The first one, we learn how to describe the business event using the debit and credit terminology, such as the new past. In the next learning object 2 and 3, we record all of the transactions in tiered accounts and show how they affect on financial statement. After the record all the transactions into tiered accounts, we record the transaction using the general journal format. And we also show how they affect on the financial statement. The following step, we will work together to prepare a trial balance and explain how it is used to prepare the financial statement status from the trial balance. And if we have time, we discuss some of the financial ratio, the assets ratio, the return on assets ratio, the debt to assets ratio, and return on equity ratio to analyze the financial statement. So first, learning objective number 1, we describe the business event by using the debit and credit terminology. So, debit credit terminology, an account form known as a tiered account is a good starting point for learning double entries recording procedure. A tiered account looks like a letter T drawn on a piece of paper. The account title is written across the top of the horizontal bar of the T. So here we have a tiered account for assets account, liabilities, and equity account. The left side of any account is the debit side. The right side of any account is the credit side. So we have a credit side here. Debit means left and credit means right. That is all. Just as we have all agreed that the red light means stop and green light means go. Accountants have agreed to use these special terms to refer to different sizes of accounts. Notice that a debit can represent an increase or a decrease. Likewise, a credit can represent an increase or a decrease. Debit increase asset account and debit decrease liability and equity accounts. Credit increase liability and owners equity or stockholders equity account and decreases the assets account. In every transaction, the total dollar of assets must equal liability plus the owner's equities, and the total dollar value of all debits must equal the total dollar of all credits. So that's very important that you have to take that one. Learning objective 2, we will learn how to record transactions in tiered account and show their effect on financial statements. So let's see how debit and credit work by looking at transactions for Collins brokerage services. Collins brokerage services began the period with the following balance: 5,000 in cash and 4,000 in common stock and 1,000 in retained earnings. So here are the account balance in the T account model. So you can see that we have a three account here. Cash is an asset account. We have a common stock, stockholders equity account, and return earning of stockholder equity account. So at the beginning, the company have a balance at 5,000 in cash. So we mentioned that debit increase asset account. So we have a balance of 5,000 on debit. And for the company, they have for the common stock and the liability is always credit increase liability and equities stockholders account. So we have a credit on common stock of 4,000 balance and credit 1,000 on return earnings here. Here is the illustration of the impact on the T account model. But as we know have that asset equal liability plus owner equity, so we can develop this illustration of the impact on the financial statement as below. Asset equal liability plus the owner equity, so we have a cash 5,000 equal common stock 4,000 and return earning of 1,000. So now look at the event number 1. The Collins acquired 25,000 from the issue of common stock. This transaction increases the cash assets account and increase the common stock equity accounts. It is classified as an asset source transaction. Here is the illustration of the impact on the T account. We see the first line is a basic accounting equation: asset equal liability plus the owner shareholders equity. So when we issue the cash, the stock by cash acquired, so we have a cash increase 25,000, so we debit 25,000 on the cash account and we credit the 25,000 on the common stock account. And here's the effect of this transaction on the financial statement model that we learned from the last class. There's no effect on the income statement, but the cash flow records a 25,000 of cash inflow from the financing activity. And now we look at the transaction number 2. The company's Collins purchased $850 of supplies on account. So this transaction is increases supplies assets account and increases the accounts payable liability accounts because the company pay later. So this is classified as an asset source transaction. And here is an illustration of the impact on T account. So we have a supply account increase 850 and the account payable liability account increase 850. There's no effect on equity. Two sides, the total amount debit equals the total amount credit. And here is the illustration of this transaction on the financial statement model. So the first part is balance sheet. So we have asset equal liability plus owner equity. So total asset increase 850, liability increase 850. There's no effect on the income transaction, so on the net income, and also the no recourse on the cash flow statement. Now we look at the transaction number 3. The company collected 1,800 as an advance to provide future services over a 1-year period, which started from the 1st of March. So you remember from last time we have the case, we mentioned that this transaction increases the cash assets account and increase the unearned revenues liability account. It is classified as an asset source transaction. Here is the effect of this transaction on the financial statement model. For the balance sheet, asset increase 1,800 for cash and liability increase 1,800 for the unearned revenue. That's because the company didn't perform the services, so there's no record on the income statement. However, because the cash received of 1,800, so the cash flow statement records inflow of 1,800 for the operating activity. So here is the illustration of the impact on the T account. So for the cash, we have a debit increase of 1,800 and the unearned revenues credit for 1,800. There's no effect on equity account. Transaction number 4, Collins provided 15,760 euro dollar of services on account. So now they provided on account. It means that the client will pay them later. So this transaction will increase as accounts receivables assets account, and because they provide the service done, so this transaction increases the controlling revenue or stockholders equities account. This transaction is classified as asset source transaction. Here is the illustration of the impact on the T account. So for T account, for the asset, we have account receivable of assets account increase. So we have a debit 15,760. For liabilities, there's no liability, no obligation here, but for equity, because they increase the revenue. So we have the consulting revenues increase 15,000. It means that we credit on the revenues account. And here's the effect of this transaction on the financial statement model. Now we look at the transaction number 5. Collins purchased land for 26,000 on cash, right? So this transaction increases the land asset account and decreases the cash assets account. It is classified as assets exchange transaction. And here is the illustration of the impact on the T account. The cash have a decrease, so we have a credit of 26,000 and the land increase of 26,000. There's no effect and in the next slide you see the transaction on the financial statement model, right? So here you see that the two sides, the asset with the cash and land, the total amount of cash of assets unchanged. no effect on liability and equity, no effect on income statement, but we have uh, investing activity with the cash flow outflow of 26,000 because it's an asset exchange transaction. And now we have the transaction number. We move to the transaction number 6. The companies paid 12,000 cash for 1 year insurance policy with coverage starting from October 1st. This transaction increases this prepaid insurance asset account and decreases the cash asset account. It is classified as an asset exchange transaction. And here is the illustration of the impact on T account. So here we can see that we have the two asset accounts. The cash decrease 1,200 and the prepaid insurance account increase 1,200. So we record on the debit side. We have a total assets account is unchanged. And as usual, we look at the impact of this transaction on the financial statements model. We have a balance sheet first. The total assets, the amount is unchanged. Liability unchanged as there's no effect on the income statement, but the cash flows decrease 1,200. It means that there's a cash outflow from operating activity. Now we look at the transaction number 7. The companies collected 13,400 from accounts receivable. These transactions increases the cash assets account and decreases the accounts receivable account. This asset account, it is classified as an asset exchange transaction. And if you look at the illustration of the impact on T account, you can see that there is an impact on cash and accounts receivable. And here is the illustration of this transaction on the financial statement model. So first, there is a effect on the balance sheet. In fact, the total amount of assets after this transaction unchanged. However, we increase cash and we decrease accounts receivable. No impact on the income statement, but the cash flows, the financial statement of cash flow from operating activity records an inflow of 13,400. Now we look at the transaction number 8, event number 8, the company paid 9,500 for salaries expenses. This transaction increases the cash assets account and decreases the salaries expense equity account. It is classified as an assets use transaction. And here you can see the record of the impact of this transaction on the T account. First asset, the T account should be the cash decrease 9,500. So we record on and credit on assets account. There's no impact on liability, but there's an impact on the equity, the salaries, the expense account. Because increase the salary, so it should be decrease the equity. That's the reason why we have a debit of 8,500. And below you can see the record of this transaction impact on the financial statement models, right? So here first look at the balance sheet. We have the assets. Cash reduce 9,500. No impact on liability, but decrease of the equity 9,500. For the income statement, there's no impact on revenue, but there's an income expense of 9,500. It means that the net income decrease 9,500. And finally, there is a cash outflows in the operating activity records for 9,500. We move to the next transaction, event number 9, in which Collins paid an 800 cash dividend. So you know that after a period of operating, the company may look have a profitable. That's the reason why the company decided to pay the dividend for the shareholder or stockholder or the owner of the company. So when you pay the cash, this transaction decreases the cash assets account and decreases the equity by increasing the dividend accounts. It is classified as an asset use transaction. Here is an illustration of the impact on tier account. For asset, there's the impact on cash decrease, so we have on credit side. Equity is the dividend accounts increase, so we have a debit side, because if you increase the dividend, it means that you decrease the equity. And as usual, you can see the impact on of this transaction on the financial statements model. Asset increase and decrease 800 and equity decrease 800. No impact on the income statement. The cash flow statement recorded of 800 in outflow from the financing activity. So remember, paying dividend is the financing activity. We continue with the event number 10. The company paid 850 euro to certain accounts payable. So this transaction decreases the cash assets account and decreases the account payable liability account. It is classified as the assets use transaction. Here is the illustration of the impact of this transaction on T account. So always we have like a horizontal balance sheet or equation. Asset equal liability plus equity. So look at the asset. We know that we have asset cash decreases 850. So we have on credit side. On the other hand, the equation we have accounts payable. It means that now reduce our liability with the vendor. It means that we reduce the liability, so we have on debit side of 850. So the total amount of the credit should be equal to the amount of debit. And if we look at the impact of this transaction to the financial statement model, we will see that it have an impact on the balance sheet and also for the cash flow. Right? So for the balance sheet, the first side is the cash decrease, and the second, the another side of the equation is the liability. It means that accounts payable decrease of 850. No impact on income statement, but the cash flows statement records $850 US dollar cash outflow from operating activity. We now look at the transaction and the event 11. The company's Collins recognized 1,900 of other operating expenses on account. recognize, it means that there's no transaction impact on cash, but the company records that all of the operating expense that they may not settle to the service provider. These transactions increases the liabilities, accounts payable, right, and decreases the equity of the advertising expense. It is classified as a claim exchange transaction, and here is the illustration of this transaction and this impact on the tiered count. So when we recognize, it means that we increase the liability, right? So we increase the liability, we update on the credit side of the accounts payable. However, we also recognize our expense. It means that we increase our expense, and if we increase expense, it means that we use on debit side. So we have the total debit should be equal total credit. And finally, if you look at this impact of this transaction on the financial statements model, we see that the first, for the balance sheet, the asset equal liability plus equity, no impact on assets because it's a claim exchange transaction. So we increase the liability, but we also decrease we increase liability, but we decrease the equity, right? For income statement, there's an expenses increase of 1,900, and as a consequence of this one, the net income decreased 1,900. This for recognizing or not actualizing, so there's no impact on cash flow. From this slide, we look at the three adjustments of the company on the accounting, right? Like we mentioned before, we have to adjust some of the temporary account by end of the accounting period. The adjustment number one, the companies recognize 750 accused interest revenue. So what does it mean? Interest revenue. So during that period, the companies have money they put in the bank or they give to someone to borrow it. So now they receive a revenue. In fact, this revenue is not a cash transaction because they just recognize. It means that they adjust with their booking system. So this transaction increase assets. It means that the interest receivable, means that they will receive it in the future and increases the equity, the interest revenue. This transaction we call is the asset source transaction. So we receive we have a tiered count on the interest receivable increase 750 and the interest revenue credits of 750, and here is the effect of this transaction on the financial statement model. For balance sheets, we increase assets 750, we increase the equity, it means that interest revenue 750. For the revenue, now we have the revenue of 750. We don't have the expense now, so we have a net income of 750, and this is a non-cash transaction, so not available. So the second adjustment is December of 31st, 2013, the company have earned 15,000 of revenues that it have a deferred in event 3. It means that they receive the money in advance, but now they perform the service. This transaction decreases the liability account unearned revenue because they perform it. However, because now they perform the service, so this transaction increases the consulting revenues, equity account, and it is classified as a claim exchange transaction. So 1,800 is for 12 months. Uh, Revenue is calculated by for 12 months. So it means that every month the company will receive the revenue of 150 US dollar per month. Because if you count from the end of December, it means that there is a 10 month. So the total revenue that they receive should be 100. The average revenue per month multiplied by the month that they service, so it means that 1,500.
Bien, ne fermez pas, ça convient pas, bientôt.